Hello, I'll be explaining the double entry principle in accounting. The double entry principle means that for every business transaction, there'll be at least two accounting entries. For example, if you buy equipment cash, there'll be an increase in equipment, but there'll also be a decrease in cash, hence two entries. The double entry principle also means that the accounting equation, which states assets equals equity plus liabilities, will hold true after each business transaction. Let's say the equipment was acquired for 10,000 Rand. There'll be an increase in assets in the form of equipment of 10,000 Rand, but there'll also be a decrease in assets in the form of cash of 10,000 Rand. It will therefore zero out. Equity and liabilities will not be impacted. The accounting equation will therefore have a 0 for assets, 0 for liabilities, and 0 for equity. Let's look at a few more examples.
The first entry states that the owner contributes 10,000 Rand to the business. When the owner contributes resources to the business, there's an increase in equity in the form of capital. Equity thus increases by 10,000 Rand. There's also an increase in assets as money is flowing into the business. Whatever the owner contributes will be impacted. If it was equipment, then we'd record it to the equipment account instead of the bank account. Number 2 states that there is a purchase of furniture on credit for 4,500 Rand. Furniture is an asset. Assets will thus increase by 4,500 Rand. It is a credit purchase and therefore there is an obligation to pay 4,500 Rand to whomever they are purchasing from. Liabilities will thus increase by 4,500 Rand and will record it to accounts payable, since the 4,500 Rand is payable to whom the purchase were made from. Number 3 is a payment of 1,500 Rand in respect of the purchase made in 2. Bank will decrease and thus assets will decrease by 1,500 Rand. The payment is in respect of the credit purchase of 4,500 Rand in Note 2. This is thus not an additional purchase of furniture, but a part payment on the furniture already received and accounted for. The payment should be recorded against the liability raised in Note 2. Since we created a payable of 4,500 Rand, we should now record 1,500 Rand against it, as 1,500 Rand of the 4,500 Rand are now being paid. Liabilities will therefore decrease by 1,500 Rand, which will result in a balance of 3,000 Rand in our books. Our first entry was an increase of 4,500 Rand to accounts payable, and now we are recording a decrease in accounts payable of 1,500 Rand. 4,500 minus 1,500 will leave a balance of 3,000 Rand. In number 4, services of 8,500 Rand are provided on credit. Services rendered is income, and income increases equity. They are not receiving cash for these services, and hence we cannot make an entry into bank. The services are rendered on credit, which creates a right to receive the money and is therefore an asset we call accounts receivable, since the money is receivable on the part of the business. Assets will thus increase by 8,500 Rand as a result of accounts receivable. In 5, they obtain a loan of 20,000 Rand. Money is being received, which increases assets by 20,000 Rand. We will record it to bank, and at the same time, we have to recognize a liability, as there is an immediate obligation to pay back the 20,000 Rand. Liabilities will therefore increase by 20,000 Rand as a result of the loan. Our assets increase by 12,500 Rand. This is in respect of services rendered which increases equity with 12,500 Rand as well. In 7, they receive 5,000 Rand from a debtor in respect of the transaction in Note 4. That is the rendering of services with 8,500 Rand. This is not an additional service being rendered, it is a receipt of money in respect of services already rendered. We will therefore not account for the service again, but have to account for the fact that the debtor paid off part of his or her account. Debtor is a name we use for people or businesses who purchase on credit or receive services on credit from the respective company. The receipt of 5,000 Rand results in an increase in assets in the form of money, but also results in a decrease in accounts receivable. This debtor initially owed 8,500 Rand, but by paying 5,000, the debtor now owes less. The debtor only owes 3,500 Rand against which the business can claim. In 8, stationery of 140 Rand is purchased for cash. Stationery is an expense. Expenses decrease equity. Where income increases the owner's interest or equity in a business, expenses decrease the owner's interest as expenses result in a reduction of profits available to the owner. Income increases profits, expenses decreases profits. There is thus a decrease of 140 Rand to equity. It is paid in cash, which results in a decrease in assets recognized in the bank. In 9, there is a payment of 18,000 for 6 months. Bank decreases and therefore assets decrease by 18,000 Rand. The rent expense equals 3,000 Rand per month, which is the 18,000 Rand paid for 6 months. 18,000 divided by 6 equals 3,000 Rand per month. In the books of January, we will therefore have an expense of 3,000 Rand, which decreases equity. The payment made in respect of the other months is not an expense, as an expense is a resource that has no future benefit. The moment there is a future benefit, it becomes an asset. 5 months of rental paid in advance therefore represents an asset, and the month used, in other words, January's rent, will be the expense. There is thus a prepaid expense equaling 15,000 Rand, which is 3,000 rent per month, times 5 months. Assets will increase by 15,000 Rand, which is the prepaid portion of the 18,000. Take note that we have a minus 18,000 as well as a plus 15,000 in the assets column, resulting in a net amount of minus 3,000. And we also have a minus 3,000 in the equity column, resulting in the accounting equation balancing. Always check that this is the case for each transaction. In 8, we had a minus 140 under assets and a minus 40 under equity. In 7, we had a plus and minus 5,000 in assets, resulting in a net effect of 0 on assets, and we had no entries in equity and liabilities. The accounting equation that states assets equals equity plus liabilities must hold true for each transaction. In 10, the electricity account was received but not paid. Electricity was used and therefore the expense should be recognized, and expenses decrease equity. And therefore there is a decrease in equity of 500 Rand. There was no payment, but there is an obligation to pay. Liabilities should thus be increased by 500 Rand, and the liability account is accrued expenses. This account is used to record all expenses that are still payable. The liability raised for assets bought on credit is accounts payable, and the liability account raised for all expenses incurred and not paid is called accrued expenses. With this entry, you can also note that accounting equation is still in balance. There's no entry under assets, but the entries made to equity and liabilities zeroes out with a minus to equity and an equal amount added to liabilities. The accounting equation still balances.